And I think that what we've seen, REITs have outperformed the S&P 500 clearly in the fourth quarter, which is good, but still they pulled back along with the broader market, and valuations are very attractive. So we like REITs on a yield basis as well as on an FFO multiple basis. So REITs are trading at discount to their historical valuations, which is a real positive, I think.
You point out that healthcare REITs, specifically, certain kinds of REITs had outperformed, right? And healthcare was actually a strong sector overall. Why don't you want to stick with that theme?
I think it's fully priced. I mean, what we've seen as the market got very defensive beginning in mid-year, the REIT sectors that outperformed are the classic defensive sectors, which are healthcare, what we call triple net lease and self-storage. And I think those stories are pretty well played out. We think there's much better value in the other sectors.
Such as?
Well, certainly apartments. Diana's comments about the apartment sector performing possibly relatively well compared to new home sales. If you have a good job growth market, you have household formation. And if you have household formation and new home sales are declining, that means people are renting. And so what we see with our apartment universe, which is very positive, is that the so-called lease turnover rate has been going down to all-time lows. So if people are not leaving apartments, they're staying, they're re-upping. You don't get frictional vacancy rate, you get higher rent growth. So we think that's a positive.
This is still a relatively new sector, for the market. How do you think overall it's doing? Is it battle tested? Are you getting a better sense now for when investors really want exposure here?
Well, I think to your point in terms of battle tested or cycle tested, the REITs that we like are typically going to be those companies that will outperform in an uncertain environment. And what we're looking at in 2019 is probably lower growth and possibly higher rates. We don't know, but certainly more uncertainty. So the names we like are names which are going to have very good balance sheets, typically investment grade rated balance sheets, strong management teams which have been cycle tested, and very good asset quality. So we're looking for that kind of a play. And we want to see also sectors where the demand variable looks to be pretty positive, as we think it is for apartments.
In terms of the top quality REITs, I mean, Simon Property and the retail REITs, I mean, that's certainly a top-notch name. But when you take a look at the potential store closures that still have to come down the pike, and we were just talking about Sears possibly going bankrupt and what a large footprint it has, are there REITs that you would say, you know what, this could really be a very trying time for them?
Well, I think it will be a challenge for those companies that own mediocre quality real estate. If you own good quality real estate and Sears is closing, that's a good thing. I mean, Sears has been underperforming for a long time. So Sears' productivity is very, very low. So if you have a chance as a mall owner to replace Sears with a retailer that's going to do better business, draw more traffic, and pay much higher rent, why wouldn't you want that?
Simon Property Group was one of your picks there. In the apartment space, what do you like? Who do you like best?
Well, there's two companies we like that we would highlight, Avalon Bay and Essex Property. Essex is a West Coast-focused company. And in this sector, of course, the West Coast has been the best coast, as we all know, in terms of job growth and GDP growth. Avalon Bay is bi-coastal, but both of them focus on better quality assets, have great management teams, very strong balance sheets, and we like both of them for 2019.
I think the last time we talked to you, or at least the last time I talked to you, we just learned that Amazon HQ2 was going up in Long Island City. So do you think that the impact, I mean, now that we've had a couple of months to actually sort of figure this out, is that going to be a real benefit to the REITs who operate in that area?
I think it will. It'll play out over a longer period of time. Amazon is talking about a lot of job growth, but it's going to be slow initially. But what's really good in Long Island City is that was a market that was oversupplied. So the most immediate impact, which we talked about last time, is to put that market back in balance. And clearly values have risen materially, as any broker operating in the Queens market can tell you. So we see that as a real positive in Long Island City. And we've also talked about Alexandria, which is one of our favorite picks also for 2019. Long Island City is trying to develop a life science cluster with the new university that's gone up at Roosevelt Island, and with the city behind this effort. Companies like Alexandria are investing capital in Long Island City, and that can only be good for job growth.